Hello and welcome to ET Market Smart Talk. Well, I'm your host, Shrutaj Anand, and today we have with us Naina Dakuna, co-head of fixed income at Aditya Birla Sun Life AMC, to discuss the recent RBI policy framework, its neutral stance, and the potential impact on markets and investors. Welcome, Sunana, and thanks for joining us.
Thanks so much, Shitij, for having me on your show.
Thank you so much for taking the time out. And well, no action on the rate cut, but there were a lot of unsaid things which caught the eye of analysts. What are your views on the recent policy framework?
So the RBI policy was actually very dovish. In
Hmm.
fact, there were two of the Monetary Policy Committee members who had actually voted for a accommodative stance, a change in stance.
Sure.
And later on in the press conference as well, the RBI governor also mentioned that he wants yields to go lower, and
Okay.
they are at an extremely high level. And he also mentioned that there is now some space for easing, whereas in the
Right.
previous policy, he had quite categorically said that there's not much space for easing. So we
Hmm.
clearly see this as a very dovish bias, and more importantly, there is a possibility of a rate cut in the next one or two policies.
Great. And in fact, RBI's neutral stance, and you, as you rightly pointed out, that it was a dovish pause, leaving the door for open for further rate cuts. So, what indicators or developments would you sort of look for that it could trigger such a move?
So the RBI is actually an inflation targeting central bank.
Okay.
And they use the CPI as their anchor.
Okay.
If you look at the CPI data that has been coming out, it has been extremely benign. At the lower end of RBI's tolerance limits, which is 2 to 6%. In fact, next week will be another CPI release, and we expect that to come in the band of 1.5 to 2%. So
Okay.
literally at the lower range of the RBI's tolerance. Not only the past, even if I look in the future, given the extremely good monsoons we've had, I think Kharif sowing has been good, production has been good,
Hmm.
crude prices are well under control. So it's likely that inflation continues to behave itself.
Hmm.
And hence, as a result, from an inflation perspective, given the
Sure.
mandate that they are an inflation targeting central bank, from an
Hmm.
inflation mandate, there is a fair amount of space for easing.
Okay.
However, and you asked about triggers, I think up till now, RBI has held itself back because of the fair amount of volatility and uncertainty that you see in the external markets. And
Exactly.
also because of our currency movements that we have seen in the last
Hmm.
couple of weeks and months.
Right.
I think once that stabilizes, and
Hmm.
if we get a India US pact, then
Okay.
I think those will be the triggers that will allow RBI to cut.
Absolutely. And good that you talked about inflation because my next question is also on that. In fact, the RBI has revised FY26 CPI expectations down to 2.6% and raised growth to 6.8. So, how does this balance between low inflation and higher growth influence monetary policy decisions?
So, as I said, RBI is an inflation targeting central bank, but the preamble
Mhm.
of the RBI also mentions that they need to ensure price stability while at the same time meeting the objective of growth. So,
Sure.
while it may not be there, so as a result, they need to ensure that there is adequate growth happening in the economy as well. Now, we've
Right.
seen in the last print of GDP growth, there has been a little bit of a mixed
Mhm.
picture. Why do I say mixed? It's because real GDP has come in at a higher, much elevated level, surprising markets. But when you
Yeah.
look at nominal GDP, coming in at 8.7, that was
Ah,
actually quite a mixed picture and a disappointment. Now, in a scenario where you have had, a deflator at just 0.9%, it's
yes.
very important to start looking at nominal GDP because that actually probably gives you a slightly better picture than
Mhm.
just real GDP. Because
Sure.
India does not follow the double deflation method of calculating real GDP, In times like this, when input prices and commodity prices, are actually low, WPI is low,
Right.
deflator is low. The real GDP number looks, much better, and in the way that the economy manages and is run,
Right.
most things are linked to nominal GDP. So, for example, wages and salary indexed to nominal GDP. If you're
Right.
looking at corporate profitability or revenues of their EBITDA or their profit, all of it is in nominal terms.
Sure.
We as an economy think in nominal terms. Most people think in nominal terms. It's only market guys like us who think more in real terms. So,
Sure. Sure.
we need to ensure, and I think to some extent RBI also will have their eye on that nominal growth and the fact that it has come down below 9%. No, now let's look at a little bit of history. If we take the last 25 years, let's say from 2000 to 2010, 2015, our nominal GDP was in the 13 to 15% range.
Right.
Then it moderated from, let's say, 2015 till last year, and it came down to around about the 10-11% range. Now it has come below 10%. Last print was below 9%. I think the fact that we need to maybe give a little bit of a fillip to growth, considering that inflation is well under control. I think RBI can possibly look at easing.
Absolutely. And let's move from rates and rate cut or inflation. Let's talk about the recent banking sector reforms, Sunana, especially the framework for the M&A financing and financing against listed debt security. So, how will sort of these changes impact corporate borrowing and investment flows?
So I think this policy, there were some 22 announcements that the RBI governor made,
That's
and
right.
a
Yeah.
lot of them pertained to increasing the credit flow from banks to various different parts of the economy, removing certain restrictions or guardrails that were previously there, loosening up a little bit of regulation.
Sure.
Um, so yes, we did see, the big announcement coming in terms of the fact that now banks, it's proposed that banks will be allowed to fund acquisition by Indian corporates, which was
Right.
previously the domain of just corporate bond markets
Correct.
and FIIs. And you mentioned certain other things like the banks now being allowed to lend more against shares, against units of InvITs and REITs, and there's no longer a ceiling on the quantum that can be lent against somebody holding listed debt securities. So
Sure.
I think to some extent this is the the governor's way of trying to ensure that there is a fillip to credit growth. Credit growth
Right.
has been has moderated and been at at about 10% thereunder. So it's I think their way of trying to give a little bit of fillip to the credit growth. They took a lot of other measures also for the banking system. For example, ECB norms have been proposed to be changed. The consultative paper came out last week, where
Right.
they have really liberalized the ECB borrowing mechanisms and the quantums and the issuers, etc. So
Sure.
that also will help the bankers who have the Indian banks which have subsidiaries abroad, and their ability to lend via the ECB route. So I think there's a whole host of measures taken, including
Right.
a reduction, proposed reduction in risk weights for
Hmm.
residential real estate, including housing loans and MSMEs. All this,
Hmm.
I think, with an eye and with a view to try and give a fillip to credit growth in the economy.
Absolutely. And so now with improved access to fixed income and corporate bonds, what opportunities do you see for domestic investors, particularly in acquisition, financing, and long-term debt investments?
So I think with this move of them opening up the banking market also to this particular space of acquisition by Indian corporates, you will
Yeah.
likely see an entire pool of liquidity which was otherwise not available to be tapped
Hmm.
to now be available for Indian corporates. That's one. Secondly, it will create a lot of liquidity in the market when there are other participants as well. Because
Right.
prior to this, it was just primarily mutual fund market or an NBFC setup, which actually
Mm,
helped finance these acquisitions. So it will open up a huge pool of liquidity that
mm.
also will probably result in a little bit of compression of spreads. But from a market development perspective, I think there are possibilities and advantages as well.
Absolutely. And so now in the conversation, you did, highlighted that the growth seems to be slowing down. And in fact, RBI has also revised its FY26 growth projections upward, but trimmed Q3, Q4, and even Q1 FY27. So how should sort of investors interpret this mixed quarterly growth picture?
So the real GDP number that came out in Q1 of 7.8 was much higher than RBI's original expectation and projection, and
Right.
hence as a result they've had to
Fair
look to
expectations.
update that for the whole year.
Yes,
But
yes.
I think for the next half of the year and Q1 FY27,
Sure.
keeping in mind the kind of volatility expected, particularly with
Mm,
the tariffs that we are facing right now,
mm,
they've
mm.
decided
Right.
to pare down the projected real GDP numbers. So that's why you're seeing a little bit of an anomaly while the whole year number has been revised upwards.
Right.
Next few quarters onwards, it's actually been revised downwards. So the RBI governor did mention that they've taken into account, the fillip to GDP they expect from the GST cuts,
Mm.
but at the same time, the tempering down of growth expected from these tariffs, and hence, as a result, you see their projections change the way they have.
Absolutely. Well, on that note, thank you so much for sharing your insights, Anna, on the RBI policy stance, corporate financing, and opportunities in fixed income. This has been extremely insightful for our listeners. Thank you so much for your time, Anna.
Thanks so much, Hitesh, for having me. Thank you.
Thank you.